Hi there, Doug Lindsay here with 10 slides in 10 minutes. Your financial questions answered in 10 minutes or less. What is a required minimum distribution and why should you care? Through your working life, you've been building up all this wealth in tax-deferred accounts such as IRAs, 401ks, 403bs, and profit-sharing accounts. Then you retire. Many people try to preserve these accounts for numerous reasons. First, you want to try and maximize the tax-deferred growth on the accounts because when you take the money out, you pay taxes. Delaying withdrawals keeps the income off your tax return. As well, Social Security is taxable based on your income, so the less income you show, the lower taxes you'll pay on your Social Security checks. And of course, you're also trying to make the money last as long as possible. But you can't avoid your friend, Uncle Sam, forever. Once you turn 70 and a half, RMDs always start for IRAs. That's simple IRAs, SEP IRAs, and traditional IRAs, but not Roth IRAs. For other plan types like 403bs, 401ks, and profit-sharing plans, RMDs usually begin at 70 and a half. If you don't take the RMD, you will still owe Uncle Sam 50% of the amount that you missed. That's a hefty penalty that you must avoid. You have to take your first RMD the year you turn 70 and a half. Why 70 and a half? Who knows? Don't ask silly questions. Here are two examples. Mary turned 70 on February 6, 2018. She's 70 and a half 6 months later on August 6th. Her first payment is due in 2018 by December 31st. Another example. Larry turns 70 on July 23rd, 2018. He won't be 70 and a half until January 23rd of the following year. So his first payment is due December 31st of 2019. Optionally, you're allowed to delay that very first payment to April 1st of the year after you turn 70 and a half. But then that year you must take 2 distributions by December 31st. Then every year after that, 1 RMD is required by the end of the year. You can take the money out on any schedule you like, say monthly or quarterly or even annually in one big lump sum. It's a good idea to have federal and state taxes withheld. Note, you can always take more than the required minimum, you'll just owe taxes. But you can't take less, or you'll owe that evil 50% penalty. Which of your accounts have a required minimum distribution? Well, all of your pre-tax accounts, technically known as defined contribution plans, which includes IRAs, that means simples, SEPs, and traditional IRAs, but not Roths. RMDs are also due on ERISA-type plans, which include TSPs, 403bs, 401ks, 457bs, and profit-sharing plans. Oddly, Roth 401ks also have RMDs once you quit working, but withdrawals are tax-free. Once you stop working, you can avoid the Roth 401k RMD by converting your Roth 401k to a Roth IRA. What happens if I'm still working when I turn 70 and a half? With IRA accounts, it doesn't matter. The required minimum distribution is still due. You can't make contributions to a traditional IRA once you turn 70 and a half. But if you're still working and meet the IRS income rules, you can contribute to your SEP, Simple, and Roth accounts. In the ERISA-type plans, 403b, 401k, and 457b, if you're still working, you might be able to wait until after retirement to start your RMD. First, your plan has to allow it, and some don't. Second, if you're a 5% or more owner and still working, you must start your required minimums as soon as you're 70 and a half. However, you still can make contributions to these accounts while working. If you have multiple IRAs or 403bs, the SEP, Simple, and traditional IRA account values can all be combined for this calculation. 403b accounts can also be combined, but you cannot combine the values of the IRAs and 403bs together. Next, calculate the RMD for each account. Then you may take the RMD from each account separately or combine the RMDs for all accounts into one total value and take it out of one account. Roth IRAs are excluded from this calculation. If you have multiple 401k accounts, you must calculate each account separately and withdraw each RMD separately for each account. No combining is allowed in 401k accounts. Reminder, you can't combine your accounts with your spouse's accounts either. So how does this RMD calculation work? First, you get the prior year-end account balance from your statement. Say on December 31st of last year, your IRA was worth $551,250. Next, look up your life expectancy factor on the appropriate IRS table, like the one shown here. For example, at age 70, you'd use 27.4. Divide your account balance by 27.4. The result is your required minimum distribution due in the current year, in this example, $20,119. This is 3.65% of your total account value. Note that because the life expectancy number gets smaller as you age, the percentage gets bigger. For example, by age 89, the RMD will be 8.34% of the total value of your account. How do I know which table to use? Your custodian may calculate this for you, but you are ultimately responsible for the accuracy. The Uniform Life table is the most common and is used when your spouse is not the sole beneficiary, or when your spouse is the sole beneficiary and also less than 10 years younger than you. Less frequently, you'll need to use the Joint and Last Survivor table. This table is used when your spouse is the sole beneficiary and is also more than 10 years younger than you. For inherited IRAs, also known as beneficiary IRAs, use the Single Life table. This one's a little tricky, so call us if you need help. The RMD is added to your income on the front page of your 1040 and then taxed at your marginal rate. For example, say you're married filing jointly with income of $75,000 and you're accustomed to paying inside the 15% bracket. Now, you're 70 and a half and must take an RMD of $25,000 out of your $685,000 IRA. Because you're on the upper edge of the 15% bracket, almost all of your RMD will be taxed in the 25% bracket, costing you an additional $6,250 in taxes. Note there is no tax due on distributions from Roth IRAs, nor do Roth IRAs have RMDs. Also note that taking your RMD may increase the tax due on your Social Security checks. All of these issues make tax planning critical, especially between the ages of 60 and 70. There are many potential side effects of IRA distributions, many of which may increase your tax bill. The income-related adjustment for Medicare Parts B and D is based on your income from your tax return. So are the phase-outs of itemized deductions, personal exemptions, and many tax credits. That big fat RMD may also increase the amount of tax due on your Social Security check. The RMD could expose you to a surtax on net investment income, and it might reduce or eliminate financial aid for your child's education. Finally, the additional income from an RMD might reduce or eliminate Roth IRA contribution eligibility. To control these tax problems, planning ahead is key. Sometimes people think they can just add up all of their retirement accounts and take one RMD to cover it. Doesn't work. Couples sometimes get confused and think they can add up their spouses and their own retirement accounts and calculate the RMD on the total. That doesn't work either. The big one is forgetting to take the RMD altogether. Doesn't work, and the 50% penalty is stiff. If you're gifting while also taking an RMD, you may be inadvertently increasing your tax bill. There's a better way called a qualified charitable distribution, or QCD. So, unless you like big surprises at tax time, you need to plan ahead, especially from ages 60 to 70. During this time, you're making many financial decisions about pensions, Medicare, starting Social Security, and drawing from IRAs. Your choices may ultimately impact the size of your RMD at your age 70 and a half. So remember to call us when you have questions, and we'll guide you through these decisions. That's the end of this session of 10 slides in 10 minutes. Hope you enjoyed it. I'm your host, Doug Lindsay. If you need additional information, remember to go to our website, and please tune in to our next session. As always, contact us if you have questions.